Alright, hello fellow intelligent investors, welcome to my channel. My name is René Zellman, and on this channel I want to talk about ways of finding high quality businesses that are available at an attractive price. And moreover, I want to address how you can avoid expensive investing mistakes. And if you can accomplish both of these things, you have a good chance of earning above average returns. And in this particular video, I want to talk about 3 things beginner investors can or should consider before starting to invest. So without further ado, let's run the intro and get started right away.
Have you ever wondered how you can make your hard-earned money work for you? Have you ever dreamed of building generational wealth and leaving a legacy? My name is René Zellman, and I'll teach you how you can manage and invest your money with confidence, a long-term vision, and without losing your mind. Join me on my journey of intelligent investing and learn how smart people can compound their money effectively and accumulate wealth.
Alright, the first thing that you need to think about before starting to invest are your goals. Because your goals will largely determine your investment approach. Someone who wants to mainly preserve his or her wealth should obviously take a somewhat different approach than someone who's trying to maximize returns. Generally, we all have things that we want to achieve in our lives. Like, for example, some want to achieve a six-pack, maybe others dream of building a successful business, and still others want to raise a wonderful family. Maybe you want to win a certain kind of championship, you want to travel the world, or maybe you have some ambition to write a best-selling book. One major reason why goals are so critical is that goals give you orientation, and at the same time they are a powerful motivator. In fact, studies found that the more value you place on a goal, the more intense your efforts will be in order to attain it. Maybe you're familiar with the book The Millionaire Next Door, written by Thomas Stanley. In the book, 1,000 millionaires were surveyed, and researchers found that the vast majority of the millionaires operates on an annual budget, and more importantly, they all have clearly defined goals. So apparently proper money management and wealth building starts with goal setting as well. However, and this is kind of the problem, in my experience, many people have goals and dreams, but most people fail to achieve them. They get very excited about their goals at the beginning, but at some point they get distracted and eventually give up. You can basically observe this phenomenon every year. By the first week of February, most people have already given up on their New Year's resolutions. They then start waiting until they feel some kind of motivation or excitement again, and then the whole process starts over again. Maybe you're familiar with Ramy Sethi. He's quite a well-known financial guru, and he refers to this problem as the treadmill of disappointment. And I find this quite an accurate term to describe this issue. Now, why is that? That's because people don't stick to the fundamentals of goal setting. Everybody talks about these resolutions, they think about what they kind of want to change, but they aren't fully committing to their objectives. So what you need to realize here is that goals are something more substantial than dreams. In my humble opinion, financial goals are somewhat special. That's because achieving financial success usually doesn't come overnight. It usually takes extreme discipline, dedication, and repeated sacrifice. So when setting financial goals, it is particularly important to consider fundamental goal-setting principles. And high achievers such as Tony Robbins, Warren Buffett, or Richard Branson, they swear by them and attribute a large success, a part of their success, to these principles. Personally, I'm a big proponent of the SMART goal-setting principles. SMART goals are specific, measurable, attainable, relevant, and time-bound. SMART goals clarify the difference between I want to own an apartment and I will put down $500 into a savings account each month until I have finally a 20% down payment for the apartment. This is obviously a much more specific and actionable goal than the first one I mentioned. Moreover, I believe that you need to distinguish between tiny financial goals, short-term goals, medium-term goals, and long-term goals. Generally, big goals are accomplished by doing many tiny steps, and those tiny steps push you forward and ultimately help you succeed. It sounds simple and stupid, but it works. Okay, my tip number 2 is to get your asset allocation right. In my view, a common rookie mistake is choosing a too conservative asset mix. I think it's critical to understand asset allocation and why it is so important. Choosing the right asset class mix is arguably one of the most important investment decisions you will make in your investing career. This decision could be worth hundreds of thousands, if not millions of dollars. So what is an asset class? An asset class is a group of investments that look and behave similarly and are subject to the same laws and regulations. Each type of asset class has its own pros and cons, and financial products belonging to one asset class share common characteristics such as risk, returns, liquidity, tax rules, and other relevant parameters. Bonds, for example, are subject to a different set of SEC laws, that's the Securities and Exchange Commission, than stocks. And it goes without saying that it's important to understand the different asset classes before investing your money. Some common asset classes are cash, commodities, cryptocurrencies, collectibles like stamps, art or wine, bonds, stocks, and obviously real estate and property. Unfortunately, in the context of this video, we don't have the time to discuss each type of asset class in detail. But let me say this, no matter which financial expert you talk to or which investing blog you read, 99% of these people will argue that your asset allocation is the primary determinant of how risky your investment portfolio is. Generally, financial advisors focus on asset classes as a way of or to help investors diversify their portfolio and allocate their clients' money in different asset classes. However, and that is the critical point, this will almost always lower the total returns of the portfolio. And the idea that being primarily invested in just one asset class is riskier is simply not true. As Buffett says, risk comes from not knowing what you are doing. Consequently, that's not how I would approach the topic of asset allocation. In my view, the ultimate goal of investing is to grow and maximize your net worth. Any asset class that does not assist you to or in pursuing that goal should be ignored. So what you want to look at is what are the best asset classes that have A, the ability to grow over time, B, have historically provided the best returns, and C, are routinely undervalued. Moreover, I like asset classes that I can find readily and exit out of quickly. And that's stocks. To reap the benefits from compounding returns, you need to invest in asset classes that provide great long-term returns. Historically, there's been no better way to grow your wealth than investing in the stock market. There's extensive empirical data on the historical returns of various asset classes that probably provide the most objective perspective on the behavior of asset classes that you can get your hands on. For instance, according to the NYU Stern School of Business, from 1928 to 2019, the stock market has, measured by the S&P 500, that's a stock index, has grown an average of 9.71% annually, including dividends. So if you are invested too conservatively, say you invest a certain percentage into gold, a certain percentage into bonds, maybe some into stocks, you may not realize the full potential of compound interest. And this will harm your long-term results. You might not achieve the long-term financial success that you are looking to achieve. However, and let me wrap this point up here, at the end of the day, every investor will have different goals. We've addressed that in our first point, and a different kind of temperament. And their asset allocation should reflect this. If volatility, that's if the price of an asset is going up and down all the time, if this may keep you up at night, you may want to choose a more conservative asset mix that you feel comfortable with. But you will also have to accept lower returns. All right, my third tip is to become educated. Quite frankly, you should only invest in what you understand. Because another rookie mistake is to act upon the advice from questionable sources. There will always be someone in your social circle, be it a colleague, a friend, a family member, or someone else who has a great investment tip, or maybe a once-in-a-lifetime stock tip. But when it comes to purchasing investments, don't listen to these guys. Don't listen to the CNBC talking heads. Don't listen to friends, co-workers, etc. And generally ignore other people's recommendations. One of the core principles that you need to internalize is that you are not allowed to do anything with your money unless you understand it. In fact, financial planning and investing on your own seems complicated at first, but it can be really simple once it is simply explained. And by the way, explaining how investing in the stock market, how investment research, how all of this works is one of the goals of this channel. So if you want to support me with this project or on my journey, feel free to subscribe to the channel. It would help me out a great deal, I guess. As the old saying goes, an investment in knowledge pays the best interest. For example, you can achieve extraordinary results by just putting your money into a suitable low-cost index fund and then forget about it for the next couple of years, or ideally even the next decades. Once you start investing in index funds, you might become aware of the fact that you can actually achieve even better returns and beat the market by carefully choosing individual high-quality companies and invest in them for the long term. To do that though, you have to understand the firm's business model, their financials. You have to be able to read their financial statements. You have to be able to analyze the competitive environment and the innovations within the industry, the target group maybe, and so on and so forth. And then you have to wait until these high-quality businesses go on sale. And then it's the time to bet big. However, understanding business models requires you to do your homework, to do your due diligence. While investing in an index fund requires almost no time commitment, selecting individual stocks is a little more complicated and time-consuming. Again, always do your due diligence before investing. Nowadays, there are so many valuable and free resources available online that can make your life easier. Use them. They can help you make informed investment decisions. And lastly, never skip this process. It's easy to rush into an investment. You think the price might go up. You experience what generally the stock market gurus refer to as fear of missing out. You want to put your capital to work right away, or you're simply too lazy to take a closer look at the underlying fundamentals. But don't succumb to these temptations and make sure you always fully understand your investments before diving in. All right, with that being said, those are the 3 tips I would give a beginner investor before he jumps into his first investments. I hope you enjoyed the video. Again, subscribe to the channel, give it a like, leave a comment if you want to, and hopefully I see you in the next video.